Maybe you've already heard about the leaked group chats in the US, but why this is now leading to rising oil prices, and even more interestingly, how you can profit from it, we'll tell you right after the intro. Hello and welcome to a new video from Bloombridge Capital. My name is Henrik, and today we'll be talking about rising oil prices. But let's start by looking at why prices are increasing in the first place. There is one simple reason for this: a decline in supply. But what is causing this? Something interesting has actually happened here. The Houthi rebels in Yemen have partially blocked and bombarded the strait in the Red Sea. In response, the Americans have stepped up and started their counterattacks. Now, no matter what one thinks of the political drama surrounding the leaked group chats, one thing is clear. Escalating tensions in the region threaten shipping lanes, which carry large amounts of oil. As a result, oil availability on the market decreases. On top of that, if the US actively restricts oil exports from other countries, such as Venezuela, where Trump is threatening tariffs on any country importing Venezuelan oil, then it's clear that overall supply will decline and so prices will rise. But does that even matter to the United States, given the exponentially increased fracking operations, which now produce nearly as much oil as they consume? Interestingly, despite the balance between consumption and production, the US still plays a major role in global oil trade. They simultaneously export and import large amounts of oil. But why don't they just use their own oil? Well, it turns out there are different types of oil that need to be processed in specialized refineries. While fracking has allowed the US to extract large quantities of oil, it's not the type that they need, as they lack the necessary refineries to process it. Instead, one type of oil is essentially swapped for another on a global market. So in short, even a country like the US is heavily dependent on global oil trade. But now, here's the key question. How can you best profit from this situation and the rising oil prices? Well, it's simple. Invest in companies that produce oil. We prepared a few for you, so let's dive straight into the analysis. So let's start with ExxonMobil. Here we see that the price has been in a sideways phase for over a year now and hasn't moved anywhere. However, we now see the opportunity to break out of this price range soon. So far in this price range, short-term trading has been quite successful, as shown by our buying zones, but now we expect larger increases that should allow for a long-term trading entry. In fact, we already saw that with this buy zone here. But now, Trump has announced a massive tariff package that has dragged down the entire market, and so this stock as well. But this should only be temporary. And going forward, there are two scenarios in which this situation should play out. Now, one scenario is a bit more bullish. In that, we see that this sell-off here should be ending soon, here in our old buy zone actually, where it should find some support, go sideways, and then trend up. But with the momentum that we see here, and the way the price is coming down very fast, it is very likely that we might find some support here to go sideways, but then most likely trend down even further here to this red line at about $94.50, and then from there we'll find support and slowly make our way back up again. Now, how this sell-off will play out exactly is obviously hard to pinpoint at the moment, as it is mostly based on the current political factors, mainly the announced tariff packages. But how you would trade this is that you can, for one, wait for this decline to the red line down here and try to buy this low, or you might even try to get a smaller position going here already and then just wait it out and stock up the position later. Now, another very interesting stock here is Chevron, which, if you look at it now, looks very similar to ExxonMobil in that we did have a very long sideways phase here. So the outlook also is very similar. So for one, we have this smaller price range here in which we could find support at the bottom, also in the old buy zone, where we go sideways here and then find the way up, or as in the other scenario, we go down here to this green line here, which would be at around $132.50, and then find a way up from here. So both scenarios should play out very similarly, and both stocks look very promising. Which one you pick, or if you want to pick both, is up to you. Now, if you find this information helpful, we would appreciate a like and a subscription. And with that, I wish you a good week, and until next time, here at Bloombridge Capital.